All right, we are back with Gareth Soloway, continuing on the tradition of getting together when we have these major market moves, and we got a lot to talk about. Gareth, how you doing?
I'm good, doing really well. Busy as can be with this market, but doing well. Thank you.
Craziest thing I've ever seen, and I was there I wasn't in the markets in the dot-com burst, but that's when I first started like really hearing about it with people that were coming down, hiring me to build beach houses for them. They cashed out of the market before it crashed and made all
Mm.
this money. So I started kind of learning what that was all about. Didn't really do anything to it in the markets until the bottom of 2009. I had a good friend that worked on Wall Street. He was a trader with one of the top firms on Wall Street. And he's like, Greg, you got to come over here, man. This is going to be generational. So I
Wow.
dipped my toe in at the bottom of March 2009. And I don't know, I bought Citibank. I remember it was a dollar something. Bank of America was a dollar and change. Ford was a buck 90. So I made some pretty good
Mm.
moves back then. And
Amazing.
yeah, March of 2020, same thing. And then here we go again, and I had a little fun with the banks the other day. But so what are you seeing out there? What's got your eye right now?
Yeah, I mean, I think the big question is as we're coming into this Wednesday's Fed decision is what's the Fed going to say? What are they going to do? I'm in the camp for a 25 basis point hike. I think that considering less than 2 weeks ago, Jerome Powell was mentioning he might have to do 50 basis points. I can't imagine them going to zero unless the banking situation deteriorates so much more than it already has. So I'm in the camp for 25, and then I think they'll actually calm the markets by saying, hey, we're going to wait a while here. Let's see what happens, and we're going to stop the rate hikes after this one.
Yeah, yeah, and I think we're going to see, coming off the last meeting, I think he's going to give up the disinflation talk. We heard that 17 times at his last speech at the last FOMC meeting. The other thing is that he's repeated at every single meeting he would rather risk over tightening, and he has the tools to deal with that versus not tightening enough, and inflation continues to rise and get out of control. And I think a lot of people have forgotten how serious he is about that. Now, the other thing is that we all know the Fed's going to keep tightening until something breaks. And there's a big debate out there. So is what happened last weekend with SVB and a couple of the other banks, is that something breaking that would cause the Fed to pivot?
Yeah, I mean that's a good question. I do think it is a breakage. It is kind of a warning shot from the financial system that things have gotten very tricky. And again, I do look at it as a break at this point. If he continues to tighten, it's only going to get worse. I mean, we had Goldman, J.P. Morgan, Citi, Wells Fargo bailing out FRC with $30 billion, and the stock's still tanking even after that. And you're still seeing Pac West drop and on Friday and stuff. So I mean, the question is too, is the crisis even over? Is there risk of contagion? I think that's got to be the big question. Could this deteriorate further out of control if the Fed keeps hiking rates?
Yeah, yeah. And I think banks are one part of the equation. So my opinion and what I've seen from some economists is that we haven't really seen a break significant enough for a Fed pivot, much less a pause, because they have the tools to deal with it. They came out with the, BFTP program. Everybody wants to call it the BFTD, but the BFT or BTFP versus BTFD program that they came out with, is enough to keep the banks from going down, because what they're really at risk at is the bank run. In this digital age, it's literally a liquidity run on the banks that the Fed is really, propped up versus a real QE where they're buying assets, buying instruments. This is just to make depositors whole so that the banks don't go out of business trying to cover redemptions. So, from that standpoint, I don't think it's a break, in terms of a Fed pivot or a Fed pause. The other big shoe to drop that, a lot of people haven't really started talking about yet is the shadow banking industry, hedge funds, equity funds,
Yep.
pension funds, investment funds that are out there that are facing, big unrealized losses right now, potential liquidity problems if they start, seeing redemptions. That was a big issue that happened in 2009. If you remember, one of the big, gas guys blew up, T Boone Pickens. He blew
Yep.
up big time, because of that. And the third thing, that I think is still kind of under the radar is the commercial real estate market, and that whole CMBS market. That's underwater big time across the country. And I think, the longer we go with high rates, the more pressure, that market's going to have on it. And a lot of the banks are exposed to that too.
Do you think that the Fed saw the crisis of the banks? Like for me, I look at it, and this kind of drives me nuts, is that if you're the Federal Reserve, you should have your finger on the pulse of the banking system, right? That's kind of your job. And so the question is did they see this coming, or were they blindsided by this? I mean, it certainly seems like they weren't really ahead of this issue. And so to me, it's another issue of does the Fed really know what the heck they're doing? I mean, they said transitory. It wasn't transitory. They jacked rates up to try to, curtail inflation really quickly. Did they not see that this was going to have some consequences behind it?
Yeah. And what you just articulated is Fed credibility, right?
Right.
Market participants like you, nobody knows what the Fed's doing or whether they know what they're doing. So here's, what I think. I think they obviously they do stress tests and they have, guidelines and they have, capital requirements, all that type of stuff. So I think they knew what was possible. What I don't think anybody knew was how quick it would happen in the digital age, because we haven't had a bank run in the digital age. And even back in 2009, when banks were failing, depositors were not at risk. Nobody lost their deposits. It was just the banks that failed. Right. This time, depositors were at risk. That's a whole different animal and problem for the Fed that, I'm sure they talk about it. They contemplated it. They may have had something on the wall about it, but I don't think they had any idea how fast it could happen in today's world.
Yeah, I think you're right about that. And that it is amazing to see it. And I think also how fast social media can play a role with, once you see something about bank run and FRC or a bank run and SVB or, anything like that, it spreads like wildfire in the world now within seconds.
Exactly. I mean, and in the inverse of that is the meme stock craze, right? One or two little tweets from the right person and stocks, crypto can, go to the moon. You can take a bank down with one tweet. I mean, what a world we live in.
It is. It's nuts, man.
Well, let's jump into the charts, take a look at, maybe start with traditional markets, and then we'll wrap up with some crypto.
Sure, absolutely. So let me bring up my charts here. We'll take a look. So what we can see here is that we have, this is the S&P 500 chart, right? And so we've basically been, and I think people don't kind of recognize this, but what I've seen is that since really June, the markets have been in basically a chop fest, right? We've just been going sideways here. And so one of the things that I saw recently with this banking crisis is we actually broke below this trend line that's been sloping up. So to me, that's getting my attention. I want to see, do we rally next week? Do we retest that line, maybe get above it? But right now, I do think the markets all are vulnerable. And I still have it priced in that the second half of 2023, I do see us not only retesting the lows from October, but then starting to actually go down to some of these targets, maybe even as low as 3,000. So I'm in the camp where I do think that we're in for a recession. I think that, anyone who says we're not, it's going to be some soft landing. I mean, again, show me a place where the Fed has hiked this quickly, this fast, with this dramatic rise in rates. And I can't imagine us getting away with no recession whatsoever. So I think investors in stocks have to be aware of that. And I think if you factor in a recession, even a mild recession, valuations to me are still way too lofty in many of these names.
Yeah, I think they're way too lofty right now, even without a recession, just at current rate, in the current rate environment and where we're at right now. There's just the thing that gets me and in questioning the thesis, there's so much liquidity out there still that has not been removed from the system. It's just a rotation of capital, just like crypto, right? So, money rotates between Bitcoin, large cap, mid cap, small cap, and the cycle just kind of repeats itself over and over. And what we're seeing here is we saw a rotation initially into the Dow. Now it's rotated into the NASDAQ and all that in and out of bonds and the dollar. And especially with what's going on, can the market ever get to those levels, with as much capital liquidity that's out there that needs to be put to work? I mean, is that even possible now?
Yep. No, and I think that's a good point. And not only has money now rotated over the last, few days into the NASDAQ, but also crypto. I mean, not so much the altcoins, but Bitcoin and Ethereum. This is like their first test case in a long, long time, right? Their first banking crisis since the inception of Bitcoin. And you've absolutely seen a huge amount of money roll over into cryptocurrencies, specifically Bitcoin and Ethereum. And I think that's fascinating. You think about the reasoning behind the creation of Bitcoin, and here we are. I mean, this is just one of those use cases for it, and I think it adds credence. I'm still not in the camp where I think that necessarily the lows are all the way in on Bitcoin or Ethereum, but you can't deny that this just strengthens the case long term for why we need Bitcoin.
Exactly. I think it strengthens the bond play aspects of Bitcoin, store of value, hedge against inflation, all those types of things. and what you've seen is Bitcoin rally along with gold, along with bonds. Now bonds move inverse. Obviously, the lower the rate, the higher the price, the lower the price, the higher the rate. We've seen bonds rally, gold and Bitcoin chart look
Gold
very
too.
similar.
Yep.
And what's interesting about the NASDAQ, people would think, wait a minute, that's high growth, that's speculative. But what it really was the mega cap stocks in tech, Microsoft, Google, Amazon, Facebook, those are the ones that really carried the NASDAQ up the last few days. We saw a lot of inflows. And of course,
Yeah,
ARK saw record inflows through all this.
Isn't that amazing? Yeah. I mean, that's part of my issue with why I just can't see that the markets have fully bottomed, because you still see so much speculation in the market. I mean, people are just itching for 2021 all over again, like a drug addict, they're scratching at their skin. So yeah, I do think that it's at this point where like investors got to still be very wary, right? The Fed isn't going to, number one, the Fed's not going to just go to cutting rates, right? They're not going to, you're not going to see this all of a sudden, this massive pivot where interest rates miraculously go back to 1% on the Fed funds. I mean, it's just not going to happen in a long period of time. Now, are they going to finally pause? Yeah, I think that makes sense. Maybe drop rates by 2024 a tiny bit, but I just do not see them dropping rates all the way back down. And if they have to do that, the economic situation is going to be ridiculously horrible for them to do that in.
Yeah, I put a tweet out earlier, on that topic. Be careful what you wish for. Everybody wants a Fed pivot, but usually when a Fed pivots, that's not a good sign. Now, we saw right. 2017, 2018, when the credit markets cracked and the Fed pivoted, but that was a different environment. We didn't have inflation. We didn't have, all of the things that are going on. And, this is what the Fed is trying to engineer, right? They want asset devaluation. They want a higher rate, environment. That's tighter financial conditions. They want unemployment to go up, to bring demand down and to kind of cool the economy off a little bit. But see, that's the other one too. I don't know. I'm not so sure how effective they're going to be in bringing unemployment up.
Right. Yeah, no, I happen to agree. And what's interesting is too, with unemployment, right? You have seen companies, at least mega cap companies, laying off significant amounts of people, and it hasn't really had an impact yet. I am in the camp that at some point there's like a mountain kind of cliff where we do roll over it and you do see a spike, but it may take a little bit more time than even the next couple months.
Yeah, and to that point, so we've seen 10,000 jobs here, 5,000 jobs there, collectively a couple 100,000 jobs, since this tightening cycle began. We need millions of jobs lost in order for the unemployment rate to go up, because there's still millions of job openings. There's still too many openings. So when you think about that, the net effect is you need about probably, between the job openings that are out there and the job losses, it's about a $5 million or 5 million, delta there between losses, openings, and all that has to be absorbed. It's really, really interesting. And, these are the things that we've never faced, before in any economic situation that this country's been in.
I do wonder though, like, what type of jobs, right? So the job openings that I'm seeing are not necessarily the tech jobs, the Microsofts. I mean, like the Microsofts, the Metas, they're not hiring, right? But it's more like the McDonald's, the workers, so it seems like it's a type of job.
Construction, and I wonder if, industry, service.
Right. Yeah, exactly. So it's not necessarily the super high paying jobs that people want. It's more like the ones that had to raise their salary from or $12 an hour to $20 an hour that are still trying to get workers. And again, the question is, will enough people that lose their jobs at Twitter will they be looking for jobs in those places, or do we just have a shortage of those particular workers?
Yeah, that's a good. Yeah, I think the tech industry and the white collar jobs are the ones that I think you're going to see the most layoffs, because the manufacturing industry, construction industry, the service industry, they still can't get people. There's that. Yeah. That's where all your openings are, and you might see it. I mean, you remember the stories in the Great Financial Crisis, 2008-9, where hedge fund managers went to work in pizza shops because, right. I mean, there was no other work. So we saw that happen the last time. But right now it's just hard to say. And there's still a lot of tech jobs out there too. So for every tech employee that gets laid off, there's probably some jobs out there in the tech industry.
Yeah, absolutely.
Especially with, AI and everything that's going on there, and automation and robotics and just all these different things.
By the way, I mean, that's the another amazing question is that, you have the automation factor, you have the robotic factor, you have the AI factor, and you can't help but wonder in 20 years from now, is there going to be a major crisis where we've had so many jobs replaced at that point? And the other thing goes for housing too. And this is something that I've speculated on, is that, in about 20 years, you have the baby boomer generation that starts passing away quite the huge amount. And a lot of that generation, they own 1, 2 houses, right? So all of a sudden you have this massive onflow of housing potential, like amounts. And I do wonder about the housing market in 20. I mean, it's a long way off, but for me, I love this thinking about that stuff and thinking about what could happen.
It's interesting. There's so many new households created for millennials and so little inventory out there. I think the numbers are we need 5 million new units to get back to a normal level of inventory. Yep. And we just can't build them fast enough. That's been the problem. So normally you're bringing new inventory in because the population is continuing to age and continuing to grow. So you got to build new units to keep up with that demand. And the construction industry since 2009 just hasn't been able to keep up.
Do you think that the inflation aspects that are causing home prices to stay high, are we pricing out a certain amount of people that can't even afford then to buy homes, even if it's their first home or whatnot?
Yeah, absolutely. And in certain markets. So, real estate is hyper local. So it really, there's markets right now that are in serious correction territory, because of that reason, because of the affordability index. But yeah. And, the other problem is rental units. I mean, in a lot of those markets where people want to buy, rent and housing units for rent are still under pressure. And,
right.
That's a big, demand cycle that's coming out right now. And it's a big business model as a lot of builders have pivoted to build to rent communities and just building thousands of homes for rent because there's so much demand for housing and, people can't afford to buy them.
Yeah, absolutely. Crazy, man.
All right. So what are you looking at Bitcoin? And do you think that what we're seeing now with, Bitcoin, NASDAQ, gold, do you think it's all just the whole Fed pivot narrative, from what happened last weekend, or you think there's something different going on here?
Yeah, so I think that it's partial, right? So you have the Fed potentially, instead of a 50 basis point, which prior to last weekend we were kind of thinking about, now all of a sudden 0 or 25, and obviously most likely a pause after that. And then also, I think that there was this massive amount of money that flowed from bank stocks and the markets into Bitcoin, which helped push it up like we see it on the chart in front of us. And so I think it's a combination of that. I do think that once the banking situation calms down, you do see some of that money come out of crypto in terms of Bitcoin and Ethereum, but it certainly was part of that. And we saw it in gold, right? I mean, gold has had a massive run up as well. And if we think about it logically, just, the Fed going to 25 or to 0, it's not like they're dropping rates. So it doesn't necessarily tell us that gold should be ripping north of its all-time highs, but we are getting pretty close because of some of the money flow, the people taking kind of a protective measure here in these assets.
Yeah. So what are you seeing for Bitcoin? Where do you have that in your short-term, midterm view right now?
Yeah. So short-term, it's looking likely that we could retest this 28,500 area right here, which again, interestingly enough, it was your lowest point from 2021's midpoint of that cycle, that bull cycle. And it's also this low of the consolidation right here. So that's my short-term resistance right around 28.5, 28.6. If we can pierce that, then we go right to that even number of 30,000, which was right above it right here. So I'm in the camp where if we get there in the next few days, let's say by Tuesday or so, I will be actually looking to short Bitcoin at that point, considering how extended the short-term move is here. Also considering that I do expect some of the money flow that's gone from bank stocks into crypto probably does reverse back out. And remember that, in a short-term amount, people are hiding in Bitcoin, right? It's I don't trust being in the banks. I don't trust my deposits in banks maybe, but there's also a lack of trust in crypto where you don't know the regulation yet. You don't know all these different things. So you could have this yank of liquidity or money flow back and forth in these two asset classes. So it is an interesting thing to watch, but either way, I do believe that we'll pull back if we hit that 28.5 or 30,000 level.
So what are your lows that you're looking for now, are you still of the mind that, no matter what, we're just not going to avoid, ultimately a recession and, deflation in the markets?
Yeah, so I'm still in the camp as of now, Bitcoin. And again, this might sound crazy to some people, but I'm still not in the camp that we've put in a low. I don't have the factors in place on a chart that tell me that the low is in for this entire cycle. And the main reason for that too, is if you zoom out on the chart, right? If we look at this bigger picture, this again is a nice bounce. It's a fantastic percentage-wise bounce off the lows. But again, we haven't even recaptured this area here. And this is kind of my line in the sand, this 30,000, 30,500 level. So as long as we stay below that, I'm in the camp that we still can roll over. We can still maybe make new lows. I don't think, for me, it's not so much that Bitcoin is going to have another FTX scenario necessarily. It's more to me that I do believe the traditional markets are going to have a major drop. And if that happens, I'm still in the camp that Bitcoin is going to struggle as it will spread. The kind of the panic and the fear will spread across all asset classes. Maybe not so much gold, but even gold could see some selling.
Yeah. Well, if you go back and look at the 2020, the pandemic, you look at the bottom of 2009, everything went down. I mean, everything went down. The money went into bonds is really what happened. Money came out of gold, came out of everything, and went into bonds.
Yep, absolutely. And so that's kind of where I'm at right now, is that right now it's been a trader's market. I think last weekend or last Friday, I was going long Solana, Avalanche, Polygon, I was long a Bitcoin and Ethereum, and I rode them up. I sold most of those kind of midway to 3/4 of the way up, kind of towards this upper trend line. I've now started a small short position in Ethereum, but it's only 2% of my portfolio. So it's kind of just dipping the toe in the water. But if we do get up into this range, then for sure I'll be looking to add to those and start accumulating a bigger short position. Now, remember, for everyone watching, it's not like I'm going to hold that short position till 9,000, right? It's, for me, it's short-term trading. So if we were to come back into this level here, I'm out. Take my profits on the shorts. I might even go long at that point. So it's a trader's market right now. When you get these type of ups and down moves, it's actually really, really good trading environment.
Let's take a look at Ethereum.
Yeah, Ethereum's super interesting because we have this channel and you still have it. You're right at that upper level, right in here, and you're still kind of bubbling up against resistance. So that's one of the reasons why I started a little short position here in Ethereum, is just the fact that it's still struggling to get through this area of resistance right here. Now, if it does get through, you're going to head to $2,000. 2,000 was your highest pivot since it put in the low. So back in June, when it made a low of around just under 900, it had that monster rally to about 2,000. That would be your short-term resistance level on the charts. And again, that would be a level where I would add to my short at this stage.
Yeah, Ethereum's running, close with Bitcoin. Bitcoin's kind of leaving everything in the dust, which, obviously happens a lot of times. And, we've seen some instances in the past where Bitcoin's gone on a run on its own and then turned around and rolled over, and everything that was bleeding into Bitcoin kept bleeding even deeper when Bitcoin finally rolled over.
Yeah. Absolutely. Yeah. And it has been amazing. I mean, because if you look at the charts of Ethereum and Bitcoin, and this is, I don't know if we'll see an alt rally where, like, sometimes that does happen where it's kind of the second leg of the move is the alts. But I mean, Bitcoin and Ethereum have just blown the alts away. And you look at like Ethereum trading at a short-term high, basically the highest point since, going back to August of 2022. And then you also look at Bitcoin here and same thing, highest. In fact, it's the highest point going all the way back to June of 2022. But then you look at something like Solana, and Solana's had a bounce, but it's not even close to the recent high yet. Same thing with Matic. Look at Matic, not even close to the high. And what that tells me is that, again, people are looking for a safe haven. It's a safe haven move. It's not a cryptocurrency move.
Yeah, it's interesting. And, that's kind of where I'm at. I think this was all, Fed pivot narrative, but, a safety play at the same time with the bank risk, liquidity risk, all of that was facing the market. Let's take a look at a couple of the bank stocks. I played with First Republic Thursday. I played with First Republic Thursday. I got like a 68% out of that one.
Yeah. So at least on a technical basis, when I look at this, there's not much I can do with it when you get these type of collapses. And again, we saw SVB, SBNY halted, and those basically were taken over by the government. So my recommendation is, if you're going to play them with the right size, so you understand if those if something were to happen in that scenario, you don't lose a ton. The only thing you can do is go to a really large time frame, and even on a large time frame, you're basically at support, but it's the last level of support. I mean, this is it. You can see right here, $21, $23 right in here. This is your low on your weekly basis. So you want to see it. For me, I would want to see this hold $20 on a weekly close. If it gets below that, then it would make me nervous.
Yeah. And, for everybody watching, that was a completely speculative,
Yep.
that was just roll the dice, because that was, it was getting halted. And, I mean, I saw on one hand, all of the big banks were, pledging $30 million. On the other hand, it could get shut down any second if that deal was off. Yep. So I knew it was going to be short term. I bought it at $23 and I got out, right around, what was it, 38, 40, whatever 68% would be. I think it was
That's
close to
amazing,
40.
man. That's a
Yeah.
great trade.
Yeah,
Amazing
and it was a
trade.
matter of a couple of hours. Literally it happened that quick. I mean, it was down at the bottom dancing. I was like, gosh, I messed up. And then all of a sudden it started taking off. And the reason I did that was because I watched Pac West the day before do the same thing.
Yep.
And so I was like, okay, I'm gonna go ahead and give this one a shot, because I almost pulled the trigger on Pac West, and the last minute I didn't, and I watched it just shoot, and I was like, I'm not gonna miss this one. And like you said, I took an amount that I was like, you know what, if it doesn't work, whatever. But
Yeah. Yeah, and
that was a complete
I
roll of
think
the
one of
dice.
the keys, yeah, one of the keys too is that we have to keep in mind that even if these banks don't fail, the speculation right now is that they're going to have to issue, they're going to have to raise capital. And the question is, how dilutive is that to shareholders? So for me, honestly, it's actually, if it's like if you look at it and say, I'll do 100 shares, like honestly, you might end up doubling, tripling, quadrupling your money off of these levels. And then also, if it's 100 shares goes to zero, you're losing a couple $1,000s. It's not the end of the world. So there is reason to kind of think that, especially with JP Morgan and these bigger banks throwing 30,000 into FRC. It's one of those scenarios where it's like, okay, well, what's the chance of it really fully failing if the banks are now backing it, these bigger banks? I doubt they're going to let their 30 billion, go into smoke, right? They're if they have to put another 10 billion in, they probably will.
Yeah. Well, I went a little heavier than that, but
I figured you did, but I didn't want to assume.
yeah, I was much bigger position than that. But what the heck? You
It's
only
all
live once.
relative, though. Let's be fair. It's all relative, right?
It's all relative, and I'm getting old, so it's like whatever. If it
Yep.
wins, it wins. If it doesn't, it doesn't. I'm not getting old, but at my point, I still like to have some fun once in a while. But yeah, it was probably an irresponsible move, but it worked out.
Nice, man. Beautiful.
Yeah, I don't know that I'm going to dip in anymore, because I think at this point it's getting a little bit more shaky, and I'm not sure the bailouts are really there from the other banks for First Republic, and it's getting a little dicey. But yeah, that was a good one. So one other thing before we go, let's take a look at the S&P again. And what's interesting is obviously it's a very different, that sideways action. It's a very different environment now in so many ways compared to 09. But let's go back and look at 08, 09, and it did kind of the same thing.
Yeah. Let me drag that back here. So here's 08, 09 right in here.
Yeah, right when it started breaking down, it kind of did the same sort of little bit of sideways action there before it finally went off the cliff.
Yep. Yeah, kind of this. I mean, if you were going to compare it, this would be kind of the most similar sideways chop, where you did make slightly higher highs, right? And I think so one of the things that people have said is you have look at this downsloping trend line, right? So then if we look at that, but then we go back to the current thing, you actually have that same sort of thing right here, right? So you could argue that you broke out. A lot of people have said, oh, the S&P broke out, right here from this trend line sloping down. But the same thing is if we go back to 2008 or 2008, same thing happened, right? You broke above it, but then you kind of started to collapse. And that's my thinking, is that ultimately that's probably what we're going to end up doing on this market.
Oddly enough, that was back when the first banks failed back in March of 08. That was Bear Stearns. What was the other one? I can't remember that cracked. Well, Lehman was second. Lehman came in September. Bear Stearns was in March, and it was like almost to the day, the same week that SVB failed.
That's freaky. That's freaky.
So interesting. Again, very different environment. The housing market and real estate, that was so levered up in so many different ways, and everybody was exposed to it, to where now you're just talking about really, the big issue is just deposit risk on the banks right now, because the Fed put that measure in place, to help, for redemptions. But, the real estate sector and the equity sector and the venture capital sector and just all these different sectors that have lost so much value, over the last year since the Fed started on this path, you could potentially see, the same level of, a couple $1 trillion exposure out there.
Yeah, you definitely could. There's no doubt about it. And I think the unforeseen stuff is also, if you see stocks like Apple and Microsoft and these stocks really take a tumble. I mean, if they were to lose 50% of their value, I mean, you're talking trillions of dollars right there in lost value.
Yeah. Well, so still, tricky times, still a, risk off environment, but a great trading environment if you if you know what you're doing.
It is a great trading environment. And I always like to say that to people too, is always remember, we could be talking about the S&P collapsing. They could, who knows what crypto does or who knows what oil does or whatever. But remember, from these markets, the best opportunities occurred from 2008, 2009. And people have to remember that's one of the reasons why you want to keep dry powder on the side, is that, you get these opportunities. You don't want to be left behind. You want to be able to capture them.
Yeah, once the dust settles, we've seen it over and over and over. We saw it 2008-9. We saw what happened in 2020. So we have the formula, and we know that, once it gets bad enough, they're going to come back in and juice the economy. The problem is, will they do that while inflation is still a problem if things really start to crack?
Right.
That's the question.
And for me, at least, my personal opinion is that they won't in the beginning because they're too scared of repeating what happened in the past. But if you were to say to me, unemployment is at 10% and inflation's at 3%, they're coming in. There's no doubt about it. At that point, they would come in. So it's a matter of how bad it gets to me. And then does inflation at least get down to a reasonable level?
Yeah. Yeah. And, the measures they put in place so far, and I think that's what we're going to hear Powell say next week. Hey, I told you we had the tools. We used them. We're going to continue down this path. We're going to get inflation down. We have to get unemployment up. And if anything, needs to be addressed in the broad, economy, we've got the tools to address it.
Absolutely.
Yeah, cool. Well, Gareth, thanks for taking a few minutes out today. It was good to catch up again. I know people love it when we get together.
Yeah, it's always a pleasure, buddy. We have great discussions.
Yeah, awesome.